What do you think was your biggest takeaway overall from the experience?
NOI growth is the most important question to ask about when they talk about their track record, because we're in a cap rate compression environment and they might have had some successful exits.
Joe, welcome to the show.
Hey, looking forward to our conversation.
Yeah. So you and I were just bantering offline a little bit about market timing, what's going on. We've both had some challenges, but yet we are always cautiously optimistic about the future. And you're like, I think now is the time to buy. Now, I think so as well. I think now the time is time to buy, but I'd like to talk with you more about why you think that. Maybe add some perspective with Gary here on the show as well. But where are we right now in the market cycle? Because it's possible that we were all saying this, 2.5 years ago. Oh, it's time to buy. It's so cool, and with a lot more perspective behind us, maybe.
Yes.
Where do you thinking with regards to is now a good time to get into it? Should wait a little bit more? What are your thoughts?
Well, what I think is most important is to look at things that we know will happen, versus what we speculate will happen. Because when we look at things that will happen versus what we speculate will happen, then we can get a better idea of how to position our portfolios and whether now is a buying time or a selling time. And what I look at is supply and demand. And barring some black swan event, the supply is about to completely be restricted and the demand will continue. And so let's talk about that, because those are words, but let's talk about some actual stats and that will back up those words and we can dig into it a little bit. So, 217,000 apartments were built in the first half of this year. Without context, I don't know, is that good? Is that bad? I don't know. Well, here's the context. Since the year 2000, 284,000 apartments have been built in a full calendar year on average. So, on average, in a full calendar year, 284,000. But just this year alone, the first half, almost a full calendar year average, right? 217,000. So what's that tell us? Well, it tells us we're getting a bunch of apartments right now. It's flooding the market right now. And why is that? Well, why are we at historically getting a whole bunch of apartments flooding the market right now? Well, everyone on this show knows that it's because there were low interest rates a couple years ago and 3-4 years ago before that. And that made construction projects pencil, right? So construction projects penciled, and that's why they did construction projects. So those projects that penciled before the interest rate hikes, they are being leased up right now. And apartment owners are right now getting hit from multiple sides. One, with the interest rate hikes. If you have rate caps, great, but you still have to pay, to what that rate cap is, and then you got to pay for a new rate cap. Fun stuff. And then on top of that, it's a bunch of competition that you're up against. And so you'll read in the online publications right now, tons of supply hitting the market. It's not a good time to be an apartment owner. It's not fun. It's not fun, generally speaking, to be an apartment owner. And there is tons of supply hitting the market right now. They are correct. But what's being missed among the larger publications is that it's about to all dry up. It's about to fall off a freaking cliff, the supply. And that is because the new construction projects have not penciled. I know a lot of developers who are not doing development anymore. They've picked a completely different profession. And that is because the interest rates make the projects cost prohibitive. And so when you have and here's the kicker about the massive supply that's taking place right now. So as I mentioned, 217,000 new apartment units just in the first half of this year. The average occupancy nationally For the last 3 months, 94.2%.
Not enough.
94, not enough. 94.2% with this once in a generation supply wave coming and hitting the market right now. It's like, apartment owners are getting the best shot that they can the market can give them, but they're still maintaining occupancy at 94.2% despite a historic wave of new apartments coming online. So what's that tell us? Well, shit, if that supply dries up or goes down, I mean, you're going to have a lot of demand for the apartments that you own. I mean, that's just supply demand. Regardless of what happens to interest rates, you're going to have a supply demand dynamic that people want to live at places. People want to buy those places where people live, but there's not enough to go around. And so what happens when you have something that people want, but there's not enough supply of it? Price goes up. And so you're going to see that. And why is now a good time? Well, it's because we're in this window of time. Now for the next 9 to 12 months, we're in the window of time where we're still competing with those properties that penciled when interest rates were lower, but their lease ups are almost done. And then once their lease ups are done, there's no one behind them, relatively speaking. Obviously, this is a macro level conversation that we're having. It depends on the market. It depends on the submarket. It depends on the freaking neighborhood. Depends on the block. But from a macro level, this is what's taking place. And so what we can do as apartment owners is, and that's also why you're not seeing a lot of transaction take place. Well, buyers are like, well, hey, I see interest rates are higher, so I can't pay as much for the property. And owners who aren't forced to sell are like, well, I see what's right around the corner. So I'm not going to give you a really steep discount because if I can hang on for a little bit through XYZ approach, my product is going to be worth a lot more once the supply wave dries up or gets absorbed. And so now for the next 9 to 12 months, you'll still read in the newspapers, or no one reads the newspapers. You'll still read online in whatever publication you follow that there's a lot of supply. But man, that's about to be a 180 in about 9 to 12 months. And then you're going to read in those same publications, there is so much demand and there's not enough supply. And that's when you're going to start seeing cap rates compress even more. We're already seeing it now on Class A properties. We're seeing cap rates compress. And it's because things are starting to dry up. And, oh, by the way, we know what's going on with the Fed. Who knows in September? Who knows when, if this episode, I don't know if this episode will air before or after, but it's projected that the Fed will decrease rates. But let's put that completely aside for this conversation, because you can debate that till you're blue in the face on what's going to happen with interest rates. But what we know will happen, and that's what's beautiful, is that the supply demand dynamic will be in multifamily owners' favor, because when you are a developer, you have to get a permit, and those permits are public. Therefore, we have this information, and we know that it takes 18 months from start to finish. So you can see it coming 18 months away. And that's why this window of time where you can get in when there's still some favorable economics as a buyer, although you've got to find the right seller, and you got to have the seller that's motivated.
So we're not seeing a ton of motivated sellers just yet, at least in our markets. And I think it's largely in part due to what you said. If you don't have to sell and you can hold on, then you're going to hold on. But I'm curious, are you targeting any specific class of asset? Because we're seeing a lot of our peers pick up the A class because you can pick them up for below replacement cost in a lot of cases, and they're obviously much easier to manage and run. Is there anything specific that you're looking at in that area of the business?
Yeah, A class properties, because Those are the properties. Now, I was just looking at a chart 10 minutes ago. One of my investors who's investing in the deal that we're buying right now, he sent it to me, and it was fascinating. It showed office, and it showed that since 2020, the net absorption rate for office vintage. And so everyone knows that office is, just doing terrible right now, right? Across the board, right? Not so much. 2015 to present, vintage office has actually, the supply has actually decreased since 2020. It's everything else with office product. The supply has increased because people don't, working from home, and people don't need as many employees, and blah blah, blah, all sorts of the reasons that we know of. But for office product that is 2015 to now, and I can share the chart with you guys, if you want to share it with your people who are listening. The amount of supply has actually decreased because it's being absorbed. And if multifamily and office are similar in any way, it might be that, well, there's demand for a good product. There'll always be demand for a really good product. And so that's why I look at apartments. And if you can buy, as you mentioned, below replacement cost, a Class A property in a really good area. We're buying one right now, Class A property, 2021 construction, a school district, A plus school district. Tenants make 115K per year. If you can buy in that type of area, 5 minutes from Disney, and you can buy below replacement costs, at a time when you are getting the dip in the valuation, and what's coming with supply demand, most likely barring some weird event, then I say you go for the best product.
Now, here's the problem, and maybe you're seeing this as well, is that there's a lot of people are afraid. A lot of investors are parked in money market, right? They're not really investing anything because, well, they read what's going on. Maybe they've been involved. They know someone's involved. And to me, it's a shame. And I just want people to know, or maybe you can talk about the different risk profiles, like the risk adjusted return we're seeing right now versus like 2.5 years ago. I always say that the multifamily we're buying right now is like a different asset class from 2.5 years ago because of the leverage we have, where the interest rates are, where the projections are. Talk a little bit about that. Why is this such a different time to get into the asset class?
Uh, because it's being priced differently, and because we are, I mean, if you want, if in that conversation, I think you need to take a look at interest rates in that conversation. If you're going to get into how is this different, because interest rates are projected to decrease. They're projected to decrease. They're not projected to increase. They could increase, obviously, but they're projected to decrease. I think in why is this different than a couple years ago? Well, you couldn't really decrease them much more than they were decreased a couple years ago, but here you can. And so that's one. But two, the supply demand, certainly, because what we're seeing is, it looks, the curve of how much supply is hitting the market, projected at the market in the next couple of years, it drops down similar to what took place in 2008, 2009, 2010. And when that supply drops down, and you've still got a lot of money that's wanting a good investment, then your investment is more valuable. The other is, I'm a passive investor in 56 different operators, I believe, 56. So 123 deals total, and including Ashcroft deals. And when I look at when I look at from a passive investor standpoint, what would I want to take my money out of a money market that's making 5.5% right now, 5.25%, whatever it is? It's got to be compelling. And what I also look at is what will that money market do? And I am not an investment advisor, so this is just me personally how I think about it, by the way. But I think, well, will if an operator comes across a really good deal right now in this window of time, will this type of deal be available once the money market is much lower? And the answer is probably not. Because if the money market is paying lower, therefore I'm more motivated to then invest my money. Something's happening in the marketplace that has changed, and most likely it is more favorable to be a multifamily owner because interest rates have been lowered, and now accordingly the treasury has decreased, and so this period of time we could wait. I could wait, but I think I'd be missing out on this window of time where you can buy properties below replacement cost. I mean, 2021 properties below replacement cost, still get some cash flow, but then have some tremendous upside potential with what's going to take place, barring some weird thing with the supply demand.
The other thing also though is leverage is much lower now than it was, gosh, 2.5 years ago, right? So
Yeah, yeah,
and I
yeah.
I think that's a material difference in the risk profile too.
Sure. Yeah. 65, 68, 69%, depend 50, 60%, depending on the project. Yeah.
Joe, what are your thoughts on overpaying for a low interest rate assumption? Because I'm seeing that happen. That's like something that's out there as a product. I don't know how I really feel about that. I don't like that you're overpaying at the equity side, but then you do have the protection of that low interest rate. What are your thoughts on that?
It depends on, I would just say, that's, I would have to deal with that on a project by project basis. Um, I mean, it would be so nuanced. Ultimately, it's, well, how long do you have this interest rate for? Um, by overpaying, what's the cash flow still with the project? Uh, how is overpaying defined relative to comps? Okay, let me take a look at, what is that delta there? So I think it's just a case by case basis. But if you were to tell me, hey, you pay a little bit more for a fixed interest rate of 3.5% for 7 years, and you can get a class A property at a you know maybe like 5.25 cap, depending on the market, 5.5 cap. It's something to look at. So it just depends on the project.
So, what are some of the risks you see here? Obviously, there's risks, and we have a whole new appreciation for risk. Certainly, we do. What are some of the ways that you're? What are those risk factors, and then what are you doing to address them?
Well, let's start with interest rates. That's a risk factor. They're projected to go down. They could stay the same. They could go up. One of three things can happen, right? And so the property we're buying in Orlando right now, we have a fixed interest rate. So remove that risk from the table. Now, when we sell in, we're projecting 5 years. When we sell in 5 years, if all interest rates have done is gone up over those 5 years, then that's going to be harmful for the investment, obviously. It's an unlikely scenario, but anything's possible, right? But so interest rates and either you're fixing the interest rate. I'd say operations are always going to be a number one challenge. And what I've been really mindful of as a passive investor, especially as I mentioned, I'm in a bunch of deals as an LP, is I'm I'm going to, as a LP moving forward, only invest with owner operators. I'm not going to invest with groups that aren't the primary uh, group that oversees the successful execution of the business plan. because I've seen how investing with groups or people who aren't the ones who are actually overseeing the business plan or don't have the rights to oversee it because they are like a 2% owner in the GP doesn't go as well, generally speaking. So operations is a risk. But you know, at Ashcroft, we mitigate that risk. There's always risk investing with us like any other group. We mitigate that risk, or we try to mitigate that risk by having our own in-house property management company. You know, over 400 employees or so, just on the property management side. We exclusively manage only our properties. So I'd say those things come to mind.
Joe, why did you choose to invest as an LP in so many different operators? And what are some other really key data points that you pulled away from that experience?
I chose to do it because I believe in the industry. I believe in multifamily syndications. Therefore, I walk the walk and talk the talk. That's one. Two is I'm able to see what works and what doesn't work with operators, how they communicate. Uh, you two do a fantastic job of communication through thick and thin. And that's something I would applaud your group on because I passively invest with you guys. I'd say also looking at different property types with commercial real estate that interests me to see what works, what doesn't work. Primarily, I'm in multifamily, but I also have uh, a couple retail strip centers, mobile home park as an LP, and you know, a marina and all sorts of like random stuff. And then also just to build more um, alliances, you know, with influential people. If I'm a passive investor with them, there's more of an alliance there than if you know I'm just someone who does the same thing they do as an operator. So I found that to be helpful because then I can you know go to people who are operators and you know maybe I need help with something or you know I have a question, and then not that they wouldn't answer or be helpful if I wasn't passively invested with them, but it helps, right? It helps that I'm a passive investor with them. So those, and I'd say that, and I'll say one last thing is uh, going off what I said, learning what works and what doesn't work with operators, how they handle communications, what they're doing, and then seeing, you know, how can I learn from that as an operator myself? And so, you know, just imagine getting exposure to 56 different operators and seeing how they operate, and then, you know, being able to distill that info and figure out, okay, what works and what doesn't, and how can we, as my company, benefit from that. That's similar to the podcast that I did. You know, I interviewed probably over 1,500, 2,000 people before I started bringing on hosts who do the interviews now on the show. But you know, when you interview 1,500 to 2,000 people all about real estate investing and get their best advice ever, you're going to learn a couple things, right? And so similar approach to that I took to also passively investing.
What do you think was your biggest takeaway overall from the experience?
I'd say NOI growth is the most important question to ask about when they talk about their track record. Because we're in a cap rate compression environment and they might have had some successful exits, but tell me about the NOI growth that you had on those properties, because that will be the indicator of how well you are and how well of an operator you are. It's one thing to say we sold and these are the returns. That's awesome. And ultimately, that's most important. But what will help me understand some potential, you know, your potential for future results, which past results don't indicate what could happen in the future. But what will help me understand as an LP is tell me about the NOI growth you had on those properties, and tell me about the business plan. That gets to the core of if they just got into the deals and they lucked out with compressed cap rates, or if they really grew NOI and they made a difference on the ground.
It's always great jamming with you, Joe. How can people find out more about you, connect with you, and see what's going on with you guys?
You can go to ashcroftcapital.com and you can go to current offerings and you can see the deal that we're buying in Orlando that I mentioned. And you can check that out.
It's awesome. So check it out. Check out what Joe's up to with Ashcroft Capital. Joe, awesome to have you on the show today.
I enjoyed it. Thanks, you too. Thanks, everyone.